Most founders believe one thing that quietly kills their business: that without a bank loan, growth is impossible. The truth is, businesses don't fail because ideas are bad. They fail because cash runs out at the wrong time. In this video, we will show you 7 proven ways to fund your business without a bank loan, even if you're starting from zero and don't have investors waiting. These methods are practical, legal, and already used by smart founders across the US. We will explain how each one works, who should use it, and the mistakes that destroy startups early. Stay till the end, because one of these can completely change how you fund your business. Number 1. Bootstrapping. Bootstrapping means starting and growing your business using your own savings or cash flow without depending on banks or investors. This is how many successful US startups began, including well-known names in tech and e-commerce. The biggest advantage of bootstrapping is control. You don't give up equity, you don't answer to investors, and you don't carry loan pressure. But smart bootstrapping is not about burning savings blindly. It's about starting small, testing demand, and reinvesting profits back into the business. Cut unnecessary expenses, delay fancy offices, avoid hiring too early, and focus only on things that directly bring revenue. Bootstrapping forces discipline. It teaches you real business fundamentals like cash management and prioritization. This method works best if your business can start generating revenue quickly, such as services, consulting, digital products, or local businesses. Many founders prefer bootstrapping because it builds strong, sustainable companies. Number 2. Friends and family funding. Friends and family funding is one of the most common early-stage funding methods, especially in the US, but most founders make mistakes here by keeping things informal. If you use this option, treat it like a real business transaction. Clearly explain your business idea, risks involved, and how the money will be used. Decide upfront whether the money is a loan, a revenue share, or equity. Put everything in writing, even if it feels uncomfortable. This protects both sides. The advantage is speed and flexibility. Friends and family usually believe in you more than banks do. However, never raise more than you truly need and never promise guaranteed returns. Transparency is key. When done properly, this funding can give your business a strong start without interest pressure. When done poorly, it can damage relationships. So professionalism matters just as much here as it does with any external investor. Number 3. Customer funding. Customer funding is one of the smartest and safest ways to fund a business without loans. This means getting customers to pay you upfront before the product or service is fully delivered. Examples include pre-orders, advance payments, subscriptions, or retainers. Many US businesses use this model to validate demand and fund operations at the same time. The biggest benefit is zero debt and zero equity loss. Your customers become proof that your idea works. This method forces you to build something people actually want. To use customer funding successfully, be honest about timelines, deliver quality, and communicate clearly. Never overpromise. This works especially well for software, coaching, consulting, manufacturing pre-orders, and service businesses. If people are willing to pay up front, that's the strongest signal your business can get. It reduces risk and builds confidence from day one. Number 4. Crowdfunding. Crowdfunding allows you to raise money from a large number of people through platforms like Kickstarter, Indiegogo, or equity crowdfunding portals in the US. Instead of borrowing from one bank, you collect small amounts from many supporters who believe in your idea. The biggest advantage is validation. If people are willing to fund your idea publicly, it proves market demand before you scale. There are 2 main types: reward-based and equity-based crowdfunding. Reward-based works well for products, gadgets, and creative ideas, while equity crowdfunding suits startups willing to share ownership. Success depends heavily on storytelling, clear benefits, and honest expectations. You must show why your product matters and how funds will be used. Crowdfunding also builds early customers and brand awareness. However, preparation is critical. A poorly planned campaign can fail publicly. When done right, crowdfunding funds growth without debt pressure. Number 5, angel investors. Angel investors are individuals who invest their own money in early-stage businesses, usually in exchange for equity. In the US, angels often invest smaller amounts compared to venture capitalists, but bring valuable experience and networks. The real value of an angel investor is guidance. Many have already built or exited businesses. They can help you avoid expensive mistakes, open doors, and think strategically. To attract angels, you need a clear business model, early traction, and a realistic growth plan. Angels look for founders who understand their numbers and market. The downside is equity dilution, but the right angel can accelerate growth faster than bootstrapping alone. This option works best when you want mentorship along with funding. Always choose investors carefully. Bad money can cost more than no money. Number 6, strategic partnerships. Strategic partnerships involve teaming up with another business that benefits from your success. Instead of giving cash directly, partners may provide funding, technology, distribution, marketing, or operational support. In return, they get access to your product, market, or future revenue. This is a powerful but underused funding method. For example, a supplier may fund production, or a larger company may pre-purchase your solution. Partnerships reduce cash pressure and speed up growth. The key is alignment. Both sides must clearly benefit. Everything should be documented, including expectations and exit options. This approach works well for B2B, software as a services, manufacturing, and service businesses. Strategic partnerships turn collaboration into capital without loans or interest. And number 7, grants and competitions. Grants and business competitions provide funding without requiring repayment or equity. In the United States, grants are available from government programs, universities, nonprofits, and innovation funds. While competitive, grants are powerful because they don't add financial risk. Many founders ignore this option because of paperwork, but the reward is worth it. Competitions also offer exposure, mentorship, and credibility. To succeed, your business must clearly solve a real problem and meet eligibility criteria. Strong applications focus on impact, feasibility, and scalability. Grants work especially well for tech, research, sustainability, and social impact businesses. Even one grant can extend your runway significantly. Free capital is rare. Smart founders actively look for it. Before applying for a business loan, watch our video on how to fix poor business finance management so you can use your business funds more effectively. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.